Welcome to a special edition of your weekly market update. I'll be stepping in for Chad this week as he takes a well-deserved vacation. But to reiterate what Chad's been saying pretty much all of 2023 is that mortgage rates will closely follow inflation. And on that note, we received a huge Bureau of Labor Statistics jobs report for the month of December. But the headline numbers trying to fool us into thinking that the job market is still strong and still contributing towards inflation. But when we peel back the actual data on these reports, there's a little bit of a different narrative going on. So let's take a look at some of that data and look and see what the real story here is. So as you can see from the headline here, in the month of December, the Bureau of Labor Statistics is saying that we gained 216,000 jobs, and that is up 46,000 from their estimate of 170. Now, if we look at every single headline number that's come out in 2023, you'll actually notice here that with the exception of July, they have subsequently revised all of the headline numbers lower. And if you total up all the headline numbers, it comes out to about 3.14 million jobs gained in the year of 2023. And so far, they have revised that number lower by 500,000. That's actually about 16% of overall headline growth in the year of 2023. And we still got 5 more revisions to go for that year. We still got the second and third revisions for November, and we still got 3 full revisions for December. So they could revise this headline number even further, yet the market is still reacting to that headline number. Let's take a look at a little bit more data here to just discuss a little bit more in depth why you shouldn't pay attention to the headlines and instead trust an expert and look at the data. All right, so this next component here is the Business Establishment Survey, again from the Bureau of Labor Statistics. And this survey measures average hourly earnings, average weekly earnings, as well as average weekly hours worked. Now, as you can see here, it makes the job market look a little bit stronger than it actually is. Month over month, average hourly earnings is up 0.4%, bringing the year-over-year change up 4.1% from 4%. Average weekly earnings, again, up month over month by 0.1%, bringing the year-over-year to 3.8% from 3.7%. Now, a little bit of weakness is shown here in the average weekly hours worked. That dropped from 34.4 to 34.3. And doesn't seem like a big increase, but when you apply that 1/10 of an hour to the entire workforce across the US, makes a pretty big difference. Now, something to consider here with this data that's making the job market look a little bit stronger is that it's including the United Auto Workers strike pay increases. This is the first month that we're seeing that. And it's also in stark contrast to some of the ADP data that came out yesterday. Per ADP, who has a sample size of over 25 million payrolls that they manage, average weekly earnings is actually down 0.2% for job stayers. That's people who decided to stay at their current job rather than seeking new employment. And it's down 0.3% for those who decided to seek new employment. So that is in stark contrast there, and it's very interesting to note. Another point, and arguably the most important aspect here to look at, is the household survey. So let me get that pulled up for you guys, and we'll break that down together. All right, here, let me get that shared. Now, in the household survey with the BLS, they have their own job creation and job loss component. And you would expect, with a headline growth of 216,000 jobs, to kind of jive with the headline number. But as you can see, it doesn't. Per the household survey, we've actually lost 683,000 jobs in the month of December. Now, why is that? Why is the household survey saying we've lost all those jobs and the headline number says that we've gained all those jobs? Let's break it down a little bit further and you'll see why. According to the household survey, we've lost 676,000 people from the total labor force. And just so you know, these aren't people that have since passed away. These aren't people that have retired. These are more people that have stopped applying for work or haven't applied for work in the past 4 weeks and are seemingly discouraged. So what happens if we add those people back into the overall numbers? What happens if we don't fudge it? If we do that, if the 676 were counted in the unemployed ranks and in the labor force, that actually brings us to an unemployment rate of 4.13%. As you can see, the overall headline said we remained steady at 3.74%, but when we don't fudge the numbers and when we add these people back in, it actually says that the job market has gotten a little bit weaker. So that's interesting to note there. And just to drive the point home a little bit further, we can look at one final report here. And this is also part of the household survey from the BLS. Says that we've actually gained 222,000 multiple job holders. And that's an all-time high, guys. That's the highest that we've seen in the past 4 years. We've actually lost 1.5 million full-time jobs and gained 762,000 part-time jobs. So when we factor in all this data, considering that more people are holding multiple jobs, more people are not working full-time, and more people are working part-time, it makes the job market a little bit weaker than the headline data that we're seeing. And just to demonstrate this, guys, we'll go and take a look at the rate chart just to see how the markets are responding to this. And you'll kind of see what we're talking about, in that you shouldn't trust the headline numbers. All right. So as we can see here on the rate chart, we're currently holding right here at this level, about 101.11. Earlier this morning, when the Bureau of Labor Statistics data came out, we were all the way down here, 100.81. So as you can see, we've actually regained about 30 points of positive rates here. So, I mean, the market has had time to dissect the data, and as you can see, it just went up even more. We're back in the positive. The market has had time to dissect the data. The market realizes that the Bureau of Labor Statistics and the Fed likes to talk tough and say that inflation's still not under control. But as we've seen throughout 2023, their aggressive stance has gotten it under control. And the question now is going to become, when do we start cutting rates? Especially as we start to see the revisions for November and further revisions for December. The job market will be revealed to be weak. Inflation will continue to go down, and in turn, we will see rates go down. So, guys, all this means for you is keep being strong in your search, keep putting offers in. If there's anything we can do for you, don't hesitate to reach out. But now is the time before rates come down even further this year and more competition floods into the market. If there's anything we can do for you, feel free to give us a call or a text. We will be resuming weekend coverage this weekend. So call us at 312-731-4939. That's 312-731-4939. Or email us at chad@thelubingroup.com. That's chad@thelubingroup.com. Have a fantastic weekend.